investors aren't stupid. That's not to say that people in this market don't hang on in markets too long and things like that. I think if we don't believe a strategy, then we don't take it on, because our alignment's pretty pure. If we don't raise money for people, we don't get paid. So we have to believe that when we sit in front of an investor, that we believe it, and therefore they should believe it, and the manager's credible that we're working with. I was kind of listening to what people were saying about where sectors are in the cycle. I don't disagree with anything that was said, but take logistics at the moment. I agree that the pricing's got pretty sharp. That's not to say that there isn't money that's still seeking that sort of long-term sustainable income that the right locations can provide, but there's a lot more money now going to development of logistics to feed that demand. So there's a space there that could be filled. A little bit the same in resi. We've seen people, investors who want the long-term income, but others that will also now back debt providers who are providing debt to developers, who are then building resi that then provides the long-term income for other investors. So there's kind of different spaces that you can fit into each sector in each market. And I guess our job to be successful in what we do is to try and pick the ones that are the sort of sweet spots for investors at any one time. So looking ahead 6 to 12 months, because it takes time to get products to market. So we're seeing a more understanding of value add, more money going to value add, but it's very specific. It will only stick to managers that have track records. If somebody suddenly thinks, whoa, that's a good idea, I'll go and have a go at that, they won't raise any money if they haven't done it before and they haven't got a decent track record. So it's not something you suddenly jump into. But yeah, I mean, I think there's a general understanding that the markets at the prime end is extremely hot, but actually if you drop down into some of the better secondary cities, if you move into a slightly alternative sector without going mad, that there is still the ability to get proper value-add returns almost anywhere in Europe. It's getting harder in the UK, I think, but in continental Europe, it's still, there's quite a long time to go in that market, because we see some of the deals that we go right from the NPL space. This is globally NPL space right through to the prime end, and we can see what the deals that those managers are doing, and the ones at the value-add opportunistic end are finding opportunities. Even in the US still, finding value-add opportunities, because prime cities very tough, but move away from that into some of the well-balanced economies in secondary cities, and there's still opportunity there.
Okay, good. Mark, you want to
But maybe just a little bit of asking a question, as you're very heavily interacting with the investor side. We've seen that yields are at an all-time low. We are not really in a mean reverting world to some extent. Do you see that investors are changing their return requirements accordingly to lower levels, or is it still saying we stick to our old levels, we just try harder to find something?
Can I pick that up? Yeah. You very kindly referred to a survey which we're about to update in your presentation, which is the allocations monitor. And we're nearly done with the results for 15, and I'm not going to kind of blow the launch, which is early December, by giving you all the answers now. But the allocations aren't going down, let's put it that way.